Welcome back traders to Stat Oasis channel. My name is Ali Casey. Today's video is about market regime. Market regime is a great way to define a strategy based on its strengths and weaknesses. So you might design a robust strategy on an instrument, but it's not producing enough profits, or it's barely profitable, or even losing money. But you can take that and switch it to a profitable strategy easily just based on market regime without adding any more filters, because you'll find out where the strategy is performing the best. So you use that one and you just get rid of where it's not performing. So let's dive in. To start, we need to build a strategy. So we'll go to Algo Wizard and we'll use the usual engine, and let me use my preferred instrument for mean reversion, and we'll use a fixed one contract. So a simple strategy of mean reversion on the ES, as most of you know by now, the ES is a very good instrument for mean reversion. So I'll use my preferred method, which is the RSI 2 period. And when the RSI is lower than level 20, I will go long and will exit when the RSI greater than 80. So that's my long side. And we can run it. And we didn't set the data. And let me set also the commission. So we'll do 15 per trade to cover slippage, because slippage is not working here. And let me run it again. So it's a good strategy, as we know. And mean reversion, any type of mean reversion strategy will work on the ES. Now we'll do the short side. And remember, the short side on the ES is a lot faster than the long side. Usually, this works on all indexes and stocks, mostly on commodities also. On currencies, not the same way. But where usually is the short side is a lot faster. So in order to achieve the a lot faster part is basically, of course, we are still with the RSI 2 period, but instead of shorting when it's above, well, in this case 80, we want to make it faster, so we'll go to 90. So it's only when it's at 90 we will short, and we will exit the trade not when it's 10, because that's too far. Then we'll exit when it's 50. So that way the short trade will be a lot faster. And let's run that also. And it did degrade a little bit. And to see the trade analysis, you can go and look at the short side. You can see the short side profit and loss, it's actually losing money. At the end of all the trades, you're, of course, including commission and slippage, you're losing about 760. But the main part is, you can see here that the short side, the average bars is 4.44, but the long side is 7.2. So that's what I'm saying, because you need to be very fast on the short side on indexes and most of the commodities. And on the long side, it doesn't matter. So that's why we see the difference here. But the main thing is, I want to show you, is the short side is losing money, and of course the long side is making money. It's making about 77,000, and this one is losing about less than $1,000. So now if I take, of course you can go to list of trades, and then you export it as XLSX, which gives you an Excel sheet, and then you can import it into the Excel sheet. So here is the data for S&P 500, and I think I've shown this before in a separate video. But basically, the very volatile part is very low percentage, In any case, in all videos I'm using the simple market regime, which is bear, sideways, and bull, volatile, and quiet. And we can see that most of the time the S&P 500 spend it in the quiet part, but the bear, sideways, and bull, they're almost split, not evenly. Of course, there is tendencies for as all indexes to go long, and you can see that we spend almost half of the time in bull market. So based on this, I imported the SQX trades in here, and now we have it here and we can use the pivot chart on it. We can start the pivot table by bringing in the direction that we have and then the sum. So obviously we know we're making money long and we're losing money in short. But then if we bring the regime, we can see clearly that strong bull, we're losing money both ways. So the short side and the bull side, the long side, are losing money. So then this strategy is very weak in this market regime, in strong bull, and we should not trade it. Now, if we take this off, then that should increase the long side by about 30,000. That's good. So now I enhance even the long side. And also the short side, it's losing because mainly of this bull market. So in bull market, I shouldn't go short. And we know that the S&P, from the data that we have, we know that the S&P spends almost half of the time in bull market. So that's a great way. This is not an insignificant number of trades. So we should not short at all in bull market using the mean reversion strategy. And actually, if I take these three off, which is bull, sideway, and strong bull, so this one is losing 2,000, and this one 3,500, that's 55, and this one is about 17. So let's say $22,000. So this 22 now will be added to this, which is 7, let's say that's 30, and that's 45. So now my short strategy, if I don't trade it in bull, sideway, and strong bull, I'm gonna make almost $45,000 in it. This, remember, these prices all includes commission. So the strategy could be enhanced by almost $80,000 roughly. Just same code, but just trading it based on strength and weaknesses. And what do I mean by this? Remember, there is no strategy that's perfect in all regimes. It's impossible, like theoretically, it's impossible to find a strategy that performs exactly the same in every market regime. So it's like an athlete. If you're running a 100-meter race and you are number one in that race, it's not the same when you run 400 meters. You will not be number one. And I think I remember only probably one athlete who was number one at 400 meters and 100 meters. But even then, obviously, you're not number one in marathon, where you run 30 kilometers, let's say. So you can see this applies everywhere. You cannot be like excellent in math and physics and chemistry. It's impossible. Yes, you have your strengths and weaknesses. So same goes for the strategy. So this code, it's obviously very good in bear market and sideway, and it's some good in bull and strong bear. But obviously it's not performing in strong bull. And same goes for the short side. It's obviously not good in bull, sideway, and strong bull, but it's obviously very good in bear and strong bear. And you can enhance the strategy very easily just by using the market regime and not trading or trading more on those regimes. Now we took the regime and we didn't take the volatility. Now I can show you also the volatility. And here again we have something that's the quiet time is losing on both long and short. The problem with this is we're spending a lot of percentage in quiet time. So I cannot say I don't trade in quiet time. So then we need to dig deeper. So we can do the volatility and regime, and then we can find out actually where it's not performing. So we can see strong bull and normal, that's not performing well. But quiet and strong bull, it's not there. So quiet sideways, quiet bull. So since the strong bull is not available in quiet, I should only use the regime and make it simple. Just don't use this one, the strong bull, and don't focus on volatility. Of course, you can always do all of them. So you can say, okay, don't trade on normal and strong bull, normal and sideways, normal and bull, and so on and so forth. And this way, of course, when we do this, we have, like I showed you this before, we have 20 regimes then. So you can pick and choose which one, but each strategy will have a different map based on this. And if we do this, then we can easily turn a losing strategy, in this case on the short side, make it a winning strategy, and also even enhancing our winning strategy even more, just by simply following the market regime. Of course, this doesn't work only on ES. If you remember, I did a video a while ago about Canadian dollar and New Zealand dollar, and this pair is also leans toward mean reverting. And I did the strategy of Bollinger Bands, which is another way to do mean reversion. And this one is set on hourly. But even with hourly, we can see that market regime plays a role. And let's see. So this is a full backtest. So this strategy is making about 30,000. Of course, this is based on one lot. And it has long and short, and we can see that the short side is making about 3,000 and long side making about 27,000. And if we check the market regime for New Zealand dollar versus Canadian dollar, we can see it's of course totally different picture. Now it's 94% quiet, so it's hard to define the market based on volatility unless you go full volatility. Then you can see that quiet is 50, 43 is normal, and then only 4.5% volatile. But we can see we still have a good percentages based on direction. So volatility, not much, but on direction we have good separation. So let's see how this strategy performs. So even though that the market regime is based on daily data, you can still even do intraday and see how the strategy performs on the market regime. And if we go here and let's start again with the direction, and let's see our P&L, and we know that we're making a little bit of money on the short side and a lot of money on the long side. But now if we bring in the market regime, and the picture now is a lot clearer. So we know we don't make money in strong bear and strong bull on the short side, but we make money on all market regimes on the long side. So we cannot enhance the long side here based on market regime, but we definitely can enhance the short side. And the short side, if we stop this, that's 1,000. And if we stop this, that's 2,500. So we can add 3,500 to the short side, which was, so 3,500, that's huge because the short side was only making 3,100. So by using the correct market regime for this strategy, we can actually double the winnings of the short side. So you can see this is a powerful concept on any instrument. And the reason is because this is not optimizable way to calculate the direction or the volatility. This is a fixed way. So you can use it regardless of the instrument. In fact, it doesn't matter what instrument you put in here. It doesn't matter what the name is. It's the same calculation and it will produce the same data based on that time series. So whatever chart you give it, whatever time series data you give it, it will spit out these 20 squares based on volatility and direction. So again, this is a really good way to enhance any strategy. Now, of course, you have to start with a robust strategy in the first place. So that doesn't mean that you bring any strategy in and you filter these trades and it will be good, because that doesn't work. You need to have a robust strategy, and then you can enhance it based on how the strategy is performing in each market regime. So I hope this video was useful to you. As always, I'm open to questions, and you can comment below the video or send them via email. And of course, if you are in the Discord server, by all means, put your questions over there and I'll be happy to answer them. And as always, please do smash the like button, as Google like that and they're going to push it to other traders. And if you like the content of the channel, don't forget to subscribe and hit the notification bell so you'll be notified when a new video gets uploaded to the channel. And until the next video, stay safe and I'll see you soon.